Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this morning. Of course, we will be taking your questions, so make sure you do send those to Brian Rezny at reznywealth.com and visit our website, reznywealth.com. We have all kinds of groundbreaking financial reports, not only about the economy, but why annuities are dangerous for your wealth, retirement income opportunities, all the different aspects of financial management, financial planning around you, the retiree. Go to reznywealth.com. Again, learn, become educated so you can make better decisions around your portfolio and your retirement. As always, I always have a topic of the day, but we do want to take your questions. We get a lot of questions throughout our program, and it's important that we answer your questions so you can make better decisions. I want to talk just generally speaking about the economy, which again is on firm footing. We've seen some volatility as we always do. Remember that, folks. Whether you're invested in the bond market, the stock market, real estate, gold, all investment assets have inter-year volatility. It doesn't mean we're going into a recession. It doesn't mean that the world's coming to an end. It just means that is normal. And what I always try to educate investors about is volatility. It is your friend. Without volatility, you have very little chance to make any reasonable return on your money. If you can't handle any volatility, the best thing to do sometimes is just be ultra conservative and go park your money in a money market or in a CD at the local bank, because taking any kind of risk is just not appropriate for you. But if you're an investor who realizes your retirement can last 25 or 30 years, inflation has a big impact on your spending ability and your portfolio, then you want to be a smart investor, and we're going to talk about that today. A recession. The next big correction is coming. What is your risk management strategy? While we may not be in a recession right now, we will have a recession. It could be coming in the next 6 months, the next 6 years, or somewhere in between. Recessions are a normal part of the economic process. But sadly, investors are acting emotionally around the word recession. A lot of the news programs out there and news sources are really hyping up recession. If you've listened to my program for any length of time, and I've been doing radio and TV shows for well over 25 years. If you listen to my shows just in the last 4 or 5 years, all the big Wall Street firms and banks, the big ones, the ones that have been fined billions of dollars, those firms, they've been calling for recession, it seems like, every single year. And they've been wrong. So if you've listened to your so-called advisor at the big Wall Street firm or the bank, and you made changes to your portfolio in 2014 or 2015 or 2016 or 17 or 18, they called for recessions every one of those years. You would have been a big loser in your portfolio because you would have sold low and you would have redeployed money at higher ground in the stock market. So what I'm going to say is this. We will have another recession. When there is a recession and it's showing its ugly head, you want to make sure that you have a risk management strategy, which we're going to talk about today. While we may not currently be in a recession, or we may be close to one, don't have knee-jerk reactions to the news media. Make sure you have a strategy to manage the major risk, which is recession risk in your portfolio. Plain and simple, this bull market will stay in place until one of two things happen. Either a recession really appears on the horizon. Now, people could talk about recession, but you need real statistical data to show we're starting to roll over. When we really see a recession on the horizon and stocks become overvalued, like they did really in 2000, then that's the time you probably want to become more defensive. But until that really happens, stop listening to recession calls when the facts clearly are not showing a sign of recession. But when they do show signs of recession, then act accordingly with a risk management strategy. Recessions come and go. A recession normally will last 12 to 15 months on average. The recession we had back in 2008 lasted about 15 months. Equity market dropped over 50%, the stock market. But investors who did nothing, of course, had a big plunge in their portfolio. Investors that had a risk management strategy, and maybe you reduced some of your equity-based exposure when we had signs of a recession, you may have done quite well. But even if you did nothing, you wrote it all the way down, and you held your equity-based positions as long as they were quality, you probably made your money back, plus you might have even doubled your money since then. So again, recessions will come and go. They last about 12 to 15 months, and make sure part of your strategy is risk management when the next recession really shows its ugly head. What should you be doing right now? Follow a real investment strategy that always includes managing the recession risk. Remember, if you have a portfolio, part of your portfolio management strategy should be risk management for a recession. I talked about inter-year volatility. There's not much you can do about that other than decreasing the type of assets that have volatility in your portfolio. So the more volatility you typically have in a portfolio, the more risk assets you have, the potential for greater return. If you can't handle any volatility, which again is normal inter-year, whether in any investment category, then again, park your money at the bank. But remember, don't have a set it and forget it portfolio. Asset allocation that's pushed by the Wall Street firms and the banks, in my opinion, does not work. Sometimes you don't want to own equities, and sometimes you do. In a recession, you want to greatly reduce your equity-based exposure. That would be part of a risk management strategy. When a recession is really here, reduce risk assets, reduce stock allocation, risk assets. Stocks go down because earnings go down. You would want to reduce your stock allocation to the equity markets when you're seeing signs of recession, not when the recession's in full vigor, when it's showing the signs. Increase cash and short-term government bonds when you see signs of a recession. Currently, if you don't see signs of recession, keep your money invested properly based upon your overall strategy. We've got an upcoming workshop if you want to learn more about the economy and the disturbing facts why most investors are really taken advantage of. We're going to teach you the shocking facts, the true cause of poor investment returns, and how to fix it. Learn how to grow and protect your wealth from bad advice. If you'd like to meet me in person or attend one of my upcoming workshops, either in Naples or Fort Myers, limited seating, go to ReznyWealth.com right now. Click on our workshop tab for times, availability, and to sign up. As always, we try to educate you, the investor. We get a lot of retirees and pre-retirees that attend my workshops. You know why? Because they're starting to realize maybe that Wall Street firm, that broker that they have, maybe that bank that's been fined billions of dollars, maybe that annuity charlatan guy that I always talk about has sold you a bunch of crummy investments. Maybe it's time you learned a little bit about your portfolio and how to avoid bad advice, conflicts, and protect your retirement from the conflicts that are often plaguing many investors just like you. I'm going to take a quick break. I want you to go to ReznyWealth.com. I want you to download any of our groundbreaking reports. Our #1 report right now, by the way, is 3 investment risks you must avoid now. Go to ReznyWealth.com. That's ReznyWealth.com. Download that groundbreaking report. I'll be back with questions after this short message. Would you hire an arsonist to put out your house fire? Of course you wouldn't. Hello, I'm Brian Rezny, president of Rezny Wealth Management. The sad fact is, your advisor is probably burning down your retirement right now and you don't even know it. Fee only fiduciary versus suitability. Who do you entrust your life savings? A real advisor or an arsonist? Visit ReznyWealth.com for the facts. And we're back. We're taking your questions. Of course, send your questions to Brian Rezny at ReznyWealth.com. Visit our website, ReznyWealth.com. I know we're always getting a lot of calls and emails about our various free reports on our website. We have workshops that are coming up. Educate yourself. One of the biggest mistakes I find investors make is hiring a salesman to basically sell you investment products that are good for his or her firm versus your portfolio. It's sad. I see this every day. I've been managing money for over 30 years. The #1 mistake investors make is hiring a so-called advisor who's really a salesman working for the Wall Street firm, the bank, or they're selling these crummy annuities to unsuspecting investors. Do your homework, folks. Go to ReznyWealth.com, download any of our groundbreaking reports, educate and protect your money. Tom from Cape Coral, Florida. What about investing in banks and financials for dividends? Tom, excellent question. In my personal opinion, right now is not the time to invest in banks and financials. Generally speaking, banks and financials make a spread. They borrow money from the Fed. They lend money at a higher rate. The problem that's happening right now is we have interest rates that are dropping. Banks are not making the kind of profits they once did. And in reality, the lower interest rates go, especially when you have the longer term rate close to the short term rate, banks' margins, their profit margin actually could go down or be negative. I would avoid banks and financials. Unfortunately, if you do invest in any kind of index type product, they're normally part of that process. But generally speaking, don't just look at dividend when you want to invest. Look at growth of the portfolio and the potential for that dividend. You want total return, not just dividend. Unfortunately, a lot of investors will chase stocks that pay high dividends because it sounds good, but unfortunately, the portfolio value drops even though the dividend's high. Your total return may be mediocre to negative. So again, avoid financials and insurance companies. In our opinion right now, it is just not a great time. There's other better opportunities. Christy from Naples, Florida. I was invested through the entire Great Recession. We've come back a long way over the last decade to get our nest egg back. I feel our current advisor is not managing the risk like you suggest. What would you do? Christy, I would call my firm, Rezny Wealth Management, for a second opinion. We do manage larger portfolios, $500,000 and up. If you feel your current advisor is not doing the right job, or you're having doubts about their ability, or you're realizing they're not a fee-only fiduciary, or they don't have a risk management strategy as part of the management of your portfolio, give us a call. But what I would say to you is this. People often have these suspicions or they have these doubts about people they hire. It could be the person that's cutting your lawn. It could be the house cleaner. It could be your financial guy. When you start having doubts and you're realizing they're not quite doing the job that you think they're supposed to be doing, the best thing to do is find a firm and get a second opinion. But remember, when you do seek a second opinion, look for firms that are fee-only fiduciary, not fee-based. And none of these guys who sell annuities and they claim to be fiduciaries, none of these people are fiduciaries. Be careful. I talk about fiduciary a lot. Fee-only fiduciary is the only kind of firm that legally works for you, Christy, 100% of the time. No Wall Street firm, bank, or insurance company is a fee-only fiduciary money manager. None of them. So don't be bamboozled by a good sales pitch or maybe that free steak dinner at the steakhouse. Make sure you find out the qualifications and make sure they sign off in writing that they're a fee-only fiduciary money manager. Have them put it on their letterhead. That way, if they lie to you, you've got legal recourse. Don from Cape Coral, Florida. Are dividend reinvestment accounts okay for long-term investments for grandkids? Don, I would say not. The problem that you're going to have, Don, is if you start buying individual stocks for grandkids, you're buying one or two stocks. You are not diversified enough for your grandkids. What I would suggest you do is look at a broad market index, something like the S&P 500 or small cap or mid cap that is well diversified in what's called an ETF format. Exchange Traded Fund. An ETF, as an example, if you bought the S&P 500, you could buy an ETF that owns those 500 companies. It pays dividends, and it has a potential for growth. So instead of owning one or two stocks, you could buy one ETF and own 500 leading companies in the U.S. That, to me, is a great opportunity for the grandkids. Buying one or two individual stocks, no. I've been managing money for over 30 years. Managing individual stocks is a difficult endeavor, even for a real firm that manages money full-time and has a real staff doing research. It's very hard for you, the average investor or individual, to take the time and really have that knowledge. And again, you buy one or two stocks, most people will buy a stock because they've heard of it or they worked for the company. If one of those stocks out of two does not do well, that could totally sink your retirement or sink the money you put away for the grandkids. Upcoming workshop, folks. The disturbing facts most investors are shocked to learn. The true cause of poor investment returns and how to fix it. I've been managing money for over 30 years. I've taught thousands of investors how to protect their money from these non-fiduciary firms. I talk about the biggest risks you need to avoid as a retiree and pre-retiree. If you want to learn how to protect your money, if you want to know how to grow and protect your money from conflicts and bad advice, and you have a $500,000 portfolio and larger, you should attend one of my upcoming workshops. We have a workshop coming up shortly in Naples and in Fort Myers. Go to ReznyWealth.com, check out our workshop tab, look at times and availabilities, and to sign up. These workshops are excellent for any investor who's starting to have doubts either about the ability of them managing their own money or maybe doubts about who you currently entrust with your money. If you want to avoid the mistakes that plague too many retirees, you want to attend one of my upcoming workshops. You're going to learn a ton. You're going to be well educated in order to move ahead, in my opinion, in the right direction that is best for you. I'm going to take a quick break. When I come back, we're going to take more questions, more concerns, so make sure you do send your questions to Brian Rezny at ReznyWealth.com and visit our website, ReznyWealth.com, and if you want, sign up for a consultation to talk to my firm about professionally managing your retirement nest egg. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. 30 years of professionally managed investments, I've seen a lot of investors make mistakes. As I've always said, learn from others' mistakes so you can profit. Read my free report, 3 Investment Risks Investors Must Avoid Now, available on our website at ReznyWealth.com. And we're back. We're taking your questions. Of course, send them to Brian Rezny at ReznyWealth.com. Let's go to our first question. Mark from Fort Myers, Florida. I recently have been laid off 15 years at a company, and they're offering me about it on my pension. What are my best options without taking a huge tax hit? Mark, if you have a pension from a company and you've been laid off, or even if you just decided to retire, if it is in a pension plan, those are normally qualified, meaning you should be able to take that pension either as a monthly payout, if that's an option. They may also give you an option to take a lump sum or defer that pension until a further date. Find out from your human resource department what your options are. Monthly payout, lump sum. If you could take a lump sum, you can easily have a direct trustee-to-trustee transfer to an IRA account. And as long as you move a qualified account into an IRA, trustee-to-trustee, there's no tax or penalty. You can avoid that, and you can defer that income taxation until you decide you want to start taking money out of that particular account. Terry from Naples, Florida. I want to invest $500 in marijuana stocks. Can you point me in the right direction? Terry, it's a bad idea. What I will say is this, whether it's a marijuana stock or any stock that is thinly traded, but let's talk about marijuana stocks. Most of these companies are itty-bitty, teeny-weeny. And all that means is they're thinly traded. A few shares trade every day, 1,000 shares, 2,000 shares, 5,000 shares. It might sound like a lot, but it's not. What you have to be concerned about is what's called bid and ask spread. First off, I would not invest in marijuana stocks, period. I think there's better opportunities. But most marijuana stocks are thinly traded because they're little tiny companies. So as an example, thinly traded means this. The stock, you look at your screen, and it's saying you could buy the stock or the stock is currently trading at $7. When you go to buy the stock, you actually paid $9.55. Because it's thinly traded, there's called a markup. And that markup could be 10 cents, 1 cent, it could be $1 or $2, depending how thinly traded it is. When you go to sell that stock, it's saying it's selling for $7. But when you go to sell it, you only get $5.45. Bid and ask spread, the differential between what it's actually trading or selling at versus what you're going to sell it for, buy it for on either side of the equation. Never buy thinly traded stocks. It's a big mistake. And what I would say to you is this. When you start to get into these little niche areas like marijuana stocks today, they sound like there's going to be the next Apple computer. Probably not. And what I will say to you is this. Most investors who are going to make money on this are the people who start these companies versus you, the person buying that stock. I would avoid them. You might want to look at other alternative investments, things like an ETF, so you're more broad-based diversified. In my opinion, that would be a much better way to go. James from Cape Coral, Florida. I am 2 years out from retirement with approximately $450,000 in my 401k plan through my employer. I have it in a moderate risk managed plan with the employer contracted fund manager. Any suggestions on what I should be doing now? James, bottom line is this. You're going to retire in a year or two. What is your current age? And realistically, let's just say you're 65 in 2 years. You're going to have a retirement that could last 25 or 30 years based upon longevity and how long people live, especially if you're married. So combined husband-wife, 25, 30-year retirement is pretty realistic. What you have to ask yourself is this. How much money am I going to need to live on? Where is it going to come from? What is my risk tolerance for volatility inter-year? And what you need to do is put together a retirement plan. At my firm, not only do we manage wealth, but we also do the financial planning before that money's actually managed. Retirement planning is vital. I would say maybe 1 out of 100 people that we talk to have ever done a retirement plan. We feel that's vital for clients in that situation. The reason is you need to look at retirement, what's realistic, what you can spend, how inflation impacts, how that money should be invested, given your risk profile and objectives. So retirement is vitally important, and I think one of the things you might want to do is attend one of our upcoming workshops, either in Naples or in Fort Myers. We've got 2 workshops coming up, either Naples, Fort Myers. Go to our website, reznywealth.com. We're going to talk about the disturbing facts most investors are shocked to learn. I can tell you, when I do a workshop, it is educational. You're going to leave, and you're going to be like, holy cow, I wish I would have learned this 20 or 30 years ago. How much better off would we be today? I'm going to talk about the financial aspects of retirement and pre-retirement planning and investing that you've never been taught. I'm going to talk about the disturbing facts that rob your returns, how conflicts and bad advice from brokerage firms, banks, and these annuity charlatans are ruining your retirement and, in our opinion, your real returns on your money. If you want to learn more about how to protect your money, if you have a $500,000 portfolio or larger, you should attend one of our upcoming workshops. Go to reznywealth.com, go to our workshop tab for times and availability and the sign up. It's an excellent education for anybody who wants to protect against conflicts, bad advice, and financial risk in retirement. Barb from Naples, Florida. When the price is right, would it be advisable to buy a consumer staple ETF? Actually, Barb, that's a great question, and I'll tell you why. Consumer staples, remember, are things that consumers buy. 70% of the U.S. economy is consumer-driven. Consumer staples are in vogue, and I think they're really in vogue now, generally speaking, because the consumer is strong. Wages are going up, unemployment is low and going generally lower. There's a lot of jobs out there. People need consumer staples. So what I would say is for a part of your portfolio, potentially, remember, it's a sector bet. And typically, if you're going in one particular sector of the S&P 500, usually 10% would be kind of a max bet that I would put, again, depending on your risk, goals, and objectives. But that could be a good opportunity for part of your portfolio. Al from Punta Gorda, Florida. I know the market's been at an all-time high. Would it make any sense to buy into this market? I know I lost the opportunity, but will it keep going higher? How high can it go? I heard one guy say 45,000. Al, first off, if somebody gives you a number of 45,000, sure, someday it may go to 45,000. But what I would say is this. You need to look at today And you need to be looking at the next 1 to 2 years where things look like they're progressing. Generally speaking, the economy is growing. Now, we are going to have a recession at some point. It could be in 16 years, it could be next year, or somewhere in between. Managing money and putting your money to work requires daily work on the economy. That's the top-down approach. Then you look at the investments that should go in the portfolio. What I would say to you, Al, is this. You've already admitted that you've passed a lot of the opportunity up because you've been on the sidelines. You probably should hire a real money manager to manage your wealth, because clearly you might not have the time, discipline, or the talent to manage your own money. And that's okay. Most people do not. Half our clients come from the Wall Street firms, banks, and insurance companies because they're disgruntled from the bad advice. The other half come from do-it-yourself investors like yourself that are doing it themselves, but maybe not doing really the best job, and they're starting to realize it. So then they call a real money management firm like Rezny Wealth Management, and then we can help you. So I would say give us a call, schedule a consultation. Let's see if we can really build a quality portfolio and manage it professionally on a long-term basis. Ben from Naples, Florida. Should Democrats win the White House in the majority in November 2020, how will the markets react in your opinion? Generally speaking, Ben, whether it's Democrat, Republican, it doesn't have a huge impact on the overall market. So remember, just because one party's in or the other isn't really going to nosedive the economy. As an example, if the Democrats happen to get in, I think it's unlikely, but if they do, they're not going to upset the apple cart so much to really crater the economy, because then people will say, we told you so. So Democrats want a decent economy, Republicans want a decent economy. They may make some adjustments or changes, but generally speaking, I don't see a lot of significant changes to the market or the economy on either party. I will say, though, if your president has good policy and they're doing things that allow the economy to grow, that benefits everybody. I do like the policies that are currently in place, and they're helping companies, they're helping individuals, clearly, because profits are up. Employment is down, which is good for consumers, and wages are up. First time we've really seen that in over a decade. So clearly, policy does matter. Not enough time to talk about all that, but generally speaking, I would stay fully invested until you see signs of a recession. Folks, I am just about out of time. We appreciate all your questions. If you're looking for real advice and real money management 100% of the time, and you're tired of conflicts and bad advice, call Rezny Wealth Management. We manage money professionally. We want to help you grow your portfolio. We do manage portfolios that are $500,000 and larger. Go to our website, reznywealth.com, or call the number on the bottom of the screen to schedule a consultation. Never settle for bad advice. If you're questioning the direction of your portfolio, give us a call. We want to help you, get you going in the right direction, and give you advice that's in your legal best interest 100% of the time. Have yourself a safe and profitable day.